Welcome to RealCast, the weekly roundup of real assets. My name's Richard Betts. I'm joined by Nicol, Dynes, James Wallace, and also this week by Dynes. We'll also take a special focus on ESG, but let's start with the roundup of the week. Dan, what are some of the key themes that you're seeing?
There's a real shift towards the operational nature of running different real estate assets. So shopping centres, outlets, office parks, retail parks. And now we're beginning to see a lot of dialogue coming from some of these companies talking about how they're going to handle the reopening. Some centres, of course, have kept their centres open throughout this pandemic. Countries like Norway, Sweden, a few centres in Holland, those schemes from Via outlets. But also this week we saw Nineva reopening 5 of its outlets in Poland, and they're tackling issues like whether to wear masks, whether to take temperatures of customers arriving, how to welcome office workers back to their office space, if indeed that happens in certain countries. And we're waiting to see how some of the lockdowns begin to lift. It was really positive to see at the beginning of the week, Greece, Spain, Italy, all lifting some of their lockdown restrictions. And so really we're hoping to see green shoots of a return to recovery on the day-to-day running of businesses. So in many senses, it's been a very positive week.
Interesting, Dan. And I also moderated a panel for the ULI this week on the operational side with Christoph Gommer from Unibail Rodamco Westfield. And that was certainly something that they were looking at, was how to bring those shopping centres back in, what was going to be required in terms of distancing, especially with different regulations across different areas. And I think that'll be a really interesting thing to watch. And Nicol, what are your sort of picks for the week? What have you been seeing?
Citizen M has just this week made a big investment in Rome, and it wants to open a 160-room hotel, which would be its debut in Italy. So it's an interesting time to choose to make its entry into Italy. And it's also said that it plans to open more hotels after Rome. It would be Milan and then others. So there seems to be some activity in the market looking beyond the short term.
And James, what have you been seeing?
I hate to be the bearer of bad forecasts, but the picture's looking even more gloomy. And of course, this is the context in which a lot of these kind of green shoots that Dan was talking about is going to be emerging in. The European Commission last week warned that the EU faces the deepest downturn in its history, and that will manifest as a widening gulf between the North and South nations across Europe. Across the euro area, the European Commission now forecasts that the economy will shrink by 7.7%, and that includes, as you see, more than 9% falls across Italy, Spain and Greece, while France is just behind at about 8.2% and Germany at 6.5%. Even Poland, which has done so well in the last decade, including during the global financial crisis, is estimated to fall by 4.5%. So for the most part, the countries that were hurt most by the health crisis related to COVID is now going to face the greatest economic contraction, which compounds the pain. And these were the same nations that struggled so deeply during the GFC. And of course, it's spiraled the debt a lot of these nations have had to take on board, which has led to some sort of stark sort of warnings from politicians across Europe that, frankly, Southern Europe is reeling, and that there needs to be some sort of joint pan-European stimulus to maintain the stability of the region. So that's the context in Europe. Just in the US, the economic environment there has swung from the start of the year from the longest running economic expansion in its history to the fastest, deepest contraction.
3 weeks ago, we were looking at the US jobless claims and saying how extraordinary it was at that point. But looking at it now, this week, 3.2 million jobless claims, which take it up to 33 million for the States, which is extraordinary. One of the things that I wanted to pick up was, and thanks very much to Nikki Greenberg for including this in her LinkedIn, that Sidewalk Labs had pulled out of the waterfront quayside project in Toronto. And many people who were at the ULI conference only a couple of months ago, Dan Doctoroff, the chief executive, he was the dinner presenter showing us what this project would be like. And so it really is an indication of how far these things have changed.
Another deal that collapsed recently was Orion Capital Managers intended acquisition of 7 UK retail parks from Hammerson's for around £400 million. That deal was first announced in February, and there was some suggestion that might not go through. I actually discussed the sustainability of a lot of the deals in Q1 with Tom Leahy of RCA recently. He said that in the first quarter, actually, there was there was resilience for the big deals. But we're in Q2 now, and things have changed.
Nicol, we had a focus on ESG this week. What was your takeaway from the event that we ran?
There seems to be a consensus among experts that there's been a focus until now mainly on the environmental, on the E of ESG, with some success. Some Collier's data that 25% of assets in Europe are compliant now. But now the focus has shifted very much onto the S of ESG, on the social aspect, and in particular on all the wellness and health aspect for obvious reasons. So there's going to be more and more focus on that. So that when things return to normal, one of the expressions used was greenwashing is history. A few good chapters in the annual report will not be enough. The companies will actually be required to do more on the social side as well, whether it's employees or tenants. So the ESG will actually come into its own. It will be a complete picture, partly because regulations will keep becoming more stringent, so pressure from above and pressure from below.
And it was also interesting, I think, to see just the focus of attendees in terms of polls, that they are expecting there to be a significant pickup in terms of a focus on ESG more widely, and also particularly the climate emergency.
What I found interesting is seeing some of the emerging companies working into things like life sciences and other sustainable initiatives and investments. Just before the pandemic lockdown, Stuart Grant left Stanhope as MD to go and found Core Life with Graham Stanley to start focusing on things like life science and innovation clusters. And, I really see a bit of development of funds and investments, not just to capitalize on changes post-COVID, but also into consumer trends and a real appetite for things like life sciences.
I also noticed, just from Derek Russell at Hines, a focus on the Cherrywood Town Centre development, and that's beginning to talk much more about bringing people together, creating memorable experiences and inspiring social connections. And so I think that will be an interesting thing that we'll begin to see a lot more of.
I think the architecture that's going into some of these new projects, like you mentioned, the Cherrywood Town Centre development, as well as existing assets, companies like Capital and Regional, which are highly community retail focused. I mean, I think it seems like a common sense word to use at this day and age, but the real focus today seems to be on what is essential retail. And we're really seeing that sort of non-discretionary retail spend is really where the investment needs to sit.
And interesting that there have been some retail funds launched, I noticed recently. James, anything you want to pick up on the fund side?
One of the more interesting stories of the last week came from across the pond. The Canadian investment giant Brookfield has launched a $5 billion retail rescue fund to support struggling retailers during the fallout from the pandemic. So this retail revitalization program, as it's called, is to take non-controlling stakes in retailers with annual revenues in the region of 250 million plus that have been affected. So this is an investor taking on a position. It's not clear whether they are equity investors or debt investors or perhaps a hybrid. The eligibility requirements are that they must have been operating for at least 2 years. They must operate in the major markets in which Brookfield already operates, but that's globally. They need not be an actual existing Brookfield tenant. So I think there'll be a lot of retailers that will be looking at this and thinking this is an interesting contrarian play, although a lot more questions need to be answered about the structure of this fund.
Lots of interesting things to pick up there. Thanks, James, Nicol, Dan, and we'll be back next week to run through the sort of key themes for the week. And also we'll have a special focus next week on Iberia. So looking at that area just to see what's interesting there. But in the meantime, thanks very much for joining us today and look forward to seeing you again next week. Thank you.